A lot of investors are in a world of pain as the growth stocks that they loved just a few months ago and the SPAC stocks that they loved just a few months ago are down sharply. They're down big time, whether or not it's 30, 40, 50% plus. And so that is a really painful position for a lot of folks. That might mean, on the light side, it might mean that boat you were planning on buying, now you have to stick with the water taxi. For others, it's like, hey, this was my retirement money, or this is the money I live off of. And, it's a lot less now that some of these, high growth stocks that I think or thought had a lot of promise now have this haircut. So what do you do now that you've sort of suffered this loss? How do you recover from these losses? And from my personal experience working in a multi-billion-dollar hedge fund, I think there are some insights that I can share with you that might be able to be helpful for your own journey. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. My shtick is that I try to call it as I see it, and it's, and if you're interested in following my personal investment journey as I'm trying to buy what I believe can be exceptional companies or unrivaled investment stocks that I think could potentially go up hundreds or thousands %, go to unrivaledinvesting.com, click on journey. Now that I've gotten that plug out of the way, so what do? You have this huge loss, 50% plus, and you're trying to figure out, well, how do I recover from this loss? What do I do? And so there are a few steps that I think you should think about. Where one, it's sort of common wisdom, or what I believe is sort of common sense, whereas if you find yourself in a hole, first stop digging. Like, you need to understand why you're here in the first place. So if there's a stock that's driven this huge loss that you own and you're down 30, 40, 50%, and believe me, in my own personal portfolio, I have my own fair share of these. I also have my own fair share of companies that have gone on to go up several 100% or over 1,000%. And you need to size up. Well, wait a second, why are these guys going down? Is it fundamentals? Is it valuation? So understand that aspect of what's actually driving it, but also understand your risk reward. That's a key element, because it's still possible that a stock down 50% is actually still a lousy risk reward. It's very possible, in which case, you could actually still be, by still holding this position, you might actually be setting yourself up for continued declines. It's possible that something down 50% could keep going lower. So that's why, in every video I try to call out, like, look, try to understand the risk reward when you're thinking about this. What's a logical framework for thinking about that upside downside? You need to understand, even if the price is down 50%, is the risk reward attractive? The second point is that you don't need to make it back the way you lost it. I mean, a lot of people, this is sort of gambler's fatigue over here, where you make it, then you lose it, and you're like, I'm just going to keep playing this game. I'm going to double down. I'm going to keep going. And the reality is, if you have a adverse experience in one stock where it's like, oh, I've lost 50% on this one, like, you need to, as I already mentioned, reassess the thesis. Has anything changed? But you don't necessarily need to make it back via the same company. Like, if let's say you were one of the unfortunate investors in Blockbuster stock, many years ago, and you'd lost some of your money thinking, oh, this is a deep value situation. You know what? Don't bank on trying to make it back the same way you lost it. Oh, Blockbuster's going to recover. That's not the way you want to do it. You want to keep an eyes wide open approach, constantly looking at individual companies with open mind, thinking what's the appropriate risk reward. The third key aspect that I think a lot of investors struggle with is appropriate portfolio management. And this is really nuanced, because it means making the right size bets based on not only the risk reward, and that's a big component of it, and that's why I call it out in my videos, but also the risk profile of the company that you need to think about. Well, wait a second. Yeah, you might have what you believe could be a really attractive risk reward, but is there inherent risks with the business model that sort of aren't showing up in the numbers? Is there either customer concentration risk, or just business practices, or competition that could make your thoughts of a logical framework just completely go out the window? So that's why it's really important to understand, well, how much of my portfolio do I want to put into individual positions? It's definitely something that you want to consider. So let me give an example of a stock that I own, a former SPAC stock. It's subsequently merged with its end company, and it was previously STPK stock. Now it's STEM stock, or STEM stock, and they are a pioneer in energy storage, and they're projecting incredible growth this next year in 2021 and in the years ahead. And I made a video, a YouTube video, I'm going to put a little link to it here in this video, with a full detailed dive on what is STEM and what do they do and what are their growth prospects and, what does management think they can do and what's their business model. And it's down 60% from its highs. Now, when I made that video, the price still wasn't compelling. It then sold off a little bit more. I then bought some. I let my Unrivaled Investing Journey subscribers know about it. And then it continued falling. It's now down about 20% below my cost basis. And so then it's like, oh man, Daniel, like now you're facing a loss. You lost 20% on this. Like you must be super duper upset. Not at all. I am not upset at all about this. No, just kidding. I'm not upset at all about this. Why? First of all, you got to set the right expectations with every investment. I mean, the reality is, with every stock I buy, I got to say, I've got the battle scars to know that stock investing will be volatile. One of my largest positions and best investments ever was a stock that dropped 70% in a day. And that was after it fell 30% previously. So you got to understand, this is what investing is. This is the volatility is the cost of admission if you're expecting to get better returns over time. And over time, stocks are the best place to be. That said, over years and even decades, it can be a very lousy ride. So that is worth understanding. I actually called out in a separate video why, index investors could actually have, lousy returns for decades. That's a whole separate other video. So you should have the expectation, and this is how I personally set my expectations. With every stock I buy, I personally could see it drop 50%. And that would be really unpleasant, but that's the reality. That's the nature of the game. And if you've been around enough, you know that, enough of these things are going to happen. The second is also position sizing. And that's the reason why I'm not really that upset about the recent volatility with STEM stock, where it's down, 60% from its high and 20% from my personal cost basis, is that the position, as Journey subscribers know, it's well less than a 1% position in my portfolio. And so that's really small. If I was completely wrong about the risk reward with STEM stock, and the business model implodes or what have you, it's not going to change my investment portfolio. It's not going to change how I live. It's not going to dramatically change my journey. And so that's the reason why it's a relatively smaller position. Now, why did I make it a smaller position? And a lot of it just comes from understanding the type of business. And this is what I meant earlier. When you're looking at a stock, it's more than just thinking about the risk reward. It's understanding the business model and thinking about that business model risks, where it's like, well, wait a second, this is a higher risk business model at this point because it's predominantly one-time sales. If you watch the STEM video, it'll make sense. But if you have predominantly at this point a one-time sales hardware low margin business that's going to transition over time to a profitable software recurring revenue business, then that's great, but you need to know where you are today. And today it's a one-time sale unprofitable business model. Yes, it does have hyper growth potential, and that's what I'm banking on, but I fully expect it's going to be a very bumpy ride given sort of the business risks and business dynamics. So I'm going to take it one quarter at a time, recognizing that at this point in their journey, in STEM's journey, it's not really a repeat recurring revenue story. So that's worth understanding. So what am I doing from here, recognizing that I'm sitting on a 20% loss on the stock? So first of all, with investing, it's important to slow your roll. Take your time. Just because a stock price moves higher or lower doesn't mean you are forced to act. So you can take your time, watch them execute. In a lot of ways, it's for those that are familiar with playing Texas Hold'em, is that you don't have to go all in pre-flop. You can watch as the cards roll out and figure out, oh, I like these odds better. This is way better in that perspective than playing Texas Hold'em or playing any card game, in that you're continuously given more information that changes the bet. And not only does the information change, but so does the price. And sometimes there's a divergence as the information comes in favorably and the price just stays flat or even goes down just because there's fatigue. And so in those types of setups, that's where you really win, where it's like, hey, you don't have to go all in pre-flop. You start getting some good cards and you're like, wow, these are exceptional cards. And now the price is still good. Now I'm going to bet, infinite money, like that type of, that's ultimately why stocks are way better than playing cards, in my opinion. But it's the same sort of mentality of slow your roll, take your time, watch them execute. If this story is as amazing as it potentially is, okay, let's see it play out, especially for a business model that's sort of higher risk. This is way higher risk than some of the other business models that I personally own in my portfolio. So another aspect is move slowly with capital allocation. What do I mean? I mean by portfolio management when I say capital allocation. When I'm saying, like, look, you don't need to make it a 20% position overnight just because of the stock's down. You can always leg in over time. You know what, I'm going to make it a 1% position this month or a 2% position. And that's part of the reason why for Journey subscribers, each month I call out a new potential multi-bagger. That way, if you like the idea of, legging into new ideas that I've personally called out as stocks that I think can have, hundreds or thousands % upside, that way you do it over time. Each month you buy a couple % of something that you think is potentially interesting. So you don't have to move super fast and go all in at once. Take your time with your own portfolio construction. Another aspect of this in terms of thinking about how to play this is as I look at my portfolio, I'm going to move my capital into my higher conviction bets, my higher conviction business models. And so that's not only the risk reward being compelling, and that has to be a good setup, but also has to be, well, wait a second, is this business model just a beautiful business model where it's just minting cash flow and management? I'm confident they're going to reallocate it intelligently and they've got lots of opportunities. So over time, I'm going to reorient my portfolio. Yeah, I'll have these teaser positions. And this is how I personally prefer to invest, and everyone has their own journey. But, I like to take teaser positions in sort of high growth, more speculative companies like STEM, where it starts off with a smaller position, but as a company proves themselves, and maybe as STEM pivots from or transitions, as they've sold more and more effectively their hardware, and now software is a bigger piece of their business, and that's driving more of their profitability. Oh, now it's de-risked a bit. Now I can buy more. And so, that's a key aspect. Another key aspect to consider is that I provide a framework of low to high, analysis whenever I look at any stock. But once again, going from experience, like, things can often go way below what you expect, even in a bear case. And so I personally, in terms of allocating capital to my best ideas, I really prefer making my big positions when in my low case, in my downside case, I'm still penciling out 50 to 100% upside. So in my low case, still saying, yeah, I think I'm going to make money here. So right now, most of my positions that I'm seeing out there and most of the stuff that I'm seeing out there, it's closer to, yeah, I think I'll maybe make single digits % return. Things aren't super cheap that way for me personally. We're in my, base and high than it is the, hundreds of % upside sort of scenario for the positions that I'm looking for. But that does give you perspective how I think about betting, which is that you want to make the big bets when you're like, oh yeah, the low side scenario is 50 to 100% upside and the high is just crazy. The high is, crazy potential. So that is worth considering when you're thinking about this valuation range. And when you've been through enough market cycles, you know that things can get silly, as I'd argue they've been the last few months on the high side. And so one should understand things can also get very silly. Maybe that's not the right word. Things can get very painful, painful on the downside in a downturn of a market. So one should be mindful of that. I'm not just teasing you with little teaser positions. I also, in a prior video, called out Alibaba as the type of company where I am considering allocating more capital. It's a position I do own, where it's a business model that's sort of already proved itself, and I think the risk reward is pretty compelling. So you can watch that video to see what I mean. And if you're interested in learning more about the potential multi-baggers I call each month, go to unravelinvesting.com, and you can see not only the potential multi-baggers each month, but also my full portfolio, which I provide a detailed breakdown at the first week of each month. And if this video has been helpful for you in terms of thinking about how do you claw back out of these claw out of this hole from the losses over the last few months, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.